So I always want to sell 2 strikes in the money. I always take that premium and double it. That's how I determine the amount that I want to spend for my protection. And then, of course, I usually want to try to do around 3 months, depending on each stock has various dates. Recently, I ran across a trade and it only had April to July. And I'll be honest, July was just sort of too far out for me. So I did do April, which was a little less than 90 days. But I try to do 90 days for most of my trades. I will tell you, there is no black and white answer in trading. Each stock is like a child. If you've had a child, or if you don't have children, you have pets, they're all the same. I've got 4 cats that drive me insane. They all have their own unique personality and demands. And that's sort of how each stock's going to be. And each stock's not always going to have every month available for options. They won't have the volume traded that some stocks have versus others. They are all different. So you have to be flexible enough to sometimes, all right, there's not 90 days, what do I do? Or I don't do the money press. You have to bend a little, but we do try to set the ground rules here to do it. Preston has been doing Netflix over $450 stock price. You can adjust and bend these rules some, but you still want to stick with the basic bones of it. But it's just because all stocks are different. They have different characteristics. After I do this, I fill out my money press. I want to see if I can afford to do the trade. That's the number one thing I have to look at. If I can't afford to do the trade, then I don't want to do it. I check the maximum possible loss, how much of my portfolio is at risk in the trade, and then lastly, I can determine how many contracts I want to do. And then you place the orders using either a calendar or diagonal order for the trade. Now, before we work up a trade real fast, I'm going to go over the possible outcomes each week. Basically, we have the weekly option expires worthless. We buy back the weekly option for either a profit or a loss. It can go either way. I usually always buy back my weekly, even if it's 1 cent, because it frees up the margin for the following week. If you're in a small account, you're really going to need to buy back your weekly in order to sell next week's. I like to buy it back just in case these options are not considered dead until midnight Friday night. And say you had an airline stock. I know Research Mike's wife works for United Airline, or you have Boeing. I have a good friend that works for Boeing. And Boeing has a plane fall out of the sky after 4 o'clock on Friday. There's a good chance that in after hours trading, Boeing is going to drop in price. And you might then find out that your today expiration, it hasn't expired yet, the put you sold gets exercised. And you also are kind of naked because you have the next week's option, but only 1 protection. So you got 2 puts sold, 1 protection. That's why I always buy back my weekly. Plus, try finding a broker that will close out your trade or let you somehow exercise your protection if you had an expiration for the same date after 4 o'clock on a Friday. I discussed this once at the St. Augustine event Preston and I did a year or so ago, and explained that I always bought back. And I had a guy email me the next day and he said, "You are so right. I'm always going to buy back my weekly," because he hadn't bought back his weekly on a sleepover bandit trade that he did. And sure enough, his stock had something happen after hours. He actually was able to call his broker and talk to them, but he couldn't get them till Saturday morning. And they're like, "Sorry, sir, your protection expired at midnight. We can't help you." So, but I was surprised that he even found someone on the weekend. But he did find someone, but sadly it was on Saturday, not Friday. So that's why I like to always just make sure I will pay them the 1 penny back or the 2 pennies. That's where you don't want to be too piggish. My greed, I do not let take over there. I want to take the risk off. Remember, I'm all about risk. So I will always buy back the weekly I sell before I sell next week's. That's just sort of consistent. I do that consistently every week. Then I don't have to worry about having double risk exposure or being out TGIF on Friday night and find out, oh, I shouldn't be happy because my stock just tanked.
A
So,
quick question for you.
okay.
When you start the money press, you do 2 strikes in the money.
Mm-hmm.
Consistent with your weekly roll, 2 strikes in the money.
Mm-hmm.
You keep it that way.
Yes, I always do two strikes in the money every week. I make it that simple. And my protection, even when I adjust it, I will take, say I've been in the money press for about 6 weeks and I need to adjust my protection. I will take that current week's, whatever I sold the weekly for, and double it to buy my new protection. So that's sort of how I do it. And I may buy, another month out depending on what strikes are available, or expirations are available. But I do everything consistently. I always sell 2 strikes in the money. I always double the weekly to select my protection, and I always buy back my weeklies before I sell the following week. I don't know how to make it any other simpler for people. I hope that is simple for them and makes it easy for you to follow. Now, the last outcome you can have is if the stock is put to you, which, depending on your account size, you can either sell it or you can hold it and sell covered calls, or just hold it in general. If you do hold your stock, don't sell your protection, because that is still acting as a band-aid that will keep you from losing the total amount of the stock you have, the money you have in the stock. If you have been put a stock at 120 and your protection is at 100, no matter what, you're not going to lose if the stock goes down to $2 because you have that 100 put there for protection. So these are basically the outcomes we can have. And we kind of just already covered my adjustments. That's what we were talking. Well, actually, we covered how I handle the weekly. Now, if you have, by doing the journal, you will know each week the maximum possible loss that can occur. By knowing that, that's how I sleep at night. And I will go and not look at my money presses for a week. That was something I had to learn, because when I first started with Preston, there's a book on Wall Street called Don't Sell Stocks on Monday. And I would start a money press with Preston, and then Monday would be a down day. And this book talks about how Monday is always the weakest day of the week. And I would look at the money press and I would think, does Preston really know what he's doing, or why is he doing this? I don't, why did I follow him? Why did I listen to him? I would think, this is stupid. And so I would panic and I would buy back my weekly just to watch and see the week play out, and Preston would go and make all the money. If I had stayed in the trade, I would have been fine. So in order to get me to quit looking at the trade every hour on there, some of y'all are glued. I see people who put these money press trades on and they absolutely just sit at the computer and watch it every minute. That is not a life. I spend a lot of time in front of my computers, but it is not watching the tick, tick, tick of every trade on my stocks. And if you do that, you're going to panic. And you will see it. I saw gyrations all the time on stocks. They have their moments. They go up and down quite a bit each day. And so to break myself from panicking and wanting to stare at the screen is why I put that maximum possible loss on the journal. If I am willing to stomach like a $3,000 loss, then I don't worry. I know that that's the worst that can happen to me for the week. However, if you have a small account, which is usually I would consider like 10,000 or less, you don't have that luxury of being able to necessarily wait and not look at it. You don't want to get the shares put to you because you don't want to get in trouble or a margin call. So what I recommend is the last 30 minutes or somewhere toward the end of the day. Don't do this in the morning. If you do it in the morning, it's not worthwhile. Stocks are trading. They just started trading. They are moving all over the place. You get stocks put to you after the market closes. So you want to look at this near the close. And if you see that your strike, remember we went over here and talked about how these strike prices move up and down, and say you had sold, well, in this example, the 347, and it's now 3:50 in the afternoon, it is 4 strikes in the money. If it's 4 strikes or more in the money, this is the danger zone. You want to buy back the weekly that you sold because you have a small account and you cannot afford to ride out the week with it. You're more than likely going to wake up the next day and have the shares put to you. Now, not always. I've been surprised lately. Some people have been 7, 8 strikes in the money. They haven't had it put to them, which is wonderful. We, most of the time don't want stock put to us. Now, I do money presses on stocks that I do want to own. And I sometimes get disappointed if I don't get them. So this is an example here. This is another option chain from E-Trade. You can see they do purple and white. And if you had, if you sold something that's 4 more strikes in the money, that's the danger zone. All you have to do is look at this and count and see how far in the money am I. If I'm 4 or more, then I better do something. You're okay. You're not completely necessarily safe in the first 3 area of in the money. Even out of the money, you're not completely out of the woods. There might be some crazy nut out there who wants to sell. This is Sirius XM Money Press or option chain. There might be some nut out there who has a 24 put and wants to sell the stock at 24 when it's actually trading at 26. I mean, it's very rare, but we don't always know why people own options or why they want to do what they do with them. So he might call his broker up and say, I want to sell my stock at 24. So be it. If they do, then you could still get the stock put to you, but most of the time, you really are only in danger if it's 4 more strikes in the money. Does this help everyone out to make your life easy? I hope so. If after I buy it back, I will buy it back first, and then I will go and evaluate my trade. Do I want to sell next week's put? I'm going to look at the chart and determine if I want to or not. I don't know if any of y'all remember when I filled in with Crypto Kyle. I think we had a wonderful time with y'all on WoW.
Hey, quick question for you as far as, let's say your strikes for 4 strikes in the money.
Mm-hmm.
Once it hits that, doesn't matter what day it is, you'll go ahead and hold it or you'll exit.
Exactly correct. Yeah, it doesn't matter because you can be put stock anytime from the time you sell it to the expiration date. There is, you are on the hook during that whole time for possibly getting stock. So after I buy it back, I'm going to look. And when I was on with Crypto Kyle, we were looking at Starbucks, and I noticed that Starbucks had closed below the 50-day moving average. So I told everyone that I probably wouldn't sell the following week, and I would just hold the long. And if you held the long after that week, you made about a 10-point profit. And so that's something that I would look at. If the stock is trading or closed below the 50-day moving average, then I'm probably not going to sell the following week's put. I'm going to wait and see if the stock bounces back above the 50-day. Like I said, you can choose to wait before you sell another weekly. There is no law that says you have to have a weekly sold every minute that you own the long protection. I might wait a couple of days and sell then. I may just keep the long put and try to make money going down. That's what I love about the money press. We are set up for either making money going up or making money going down. And I may just close out the whole trade. I may just look at it. I may not feel like it's really going to crash enough to hold the long, but it's really not going to go up either. And I will just look at it and evaluate it. So let's see. Oh, the last step that I do each Friday, I want to go over this before I set up a real money press with you, is I will place a GTC order. GTC means good till cancel. I usually do a limit order that is 10% of the amount of the sold weekly put. So in this example here, if I sold a NVIDIA put for 420, I would put an order in to buy it back for 42 cents. That means I would make 90% of this premium. I'm happy with that. Once again, I'm talking about don't be greedy and have to have $4.19. Be happy with around 380. Some of my students don't like to do math, so they'll just do every order either 10 cents or 20 cents, no matter what the stock is. I'm fine with that. What you really want to do is if you can walk away with 80% of this weekly amount, I consider that a good trade, and the money press will usually work very well that way. And if you can walk away making 80 by Monday, Tuesday, or that's early in the week, you're out of the frying pan. You don't have to worry. This year, the market seems to like to tank on Thursday and Friday. So if I can get out before Thursday or Friday, I'm pretty happy. And we'll go with that and then maybe just sell again on Friday. So this is something that you can look at, try with, and see if you like.